U.S. stock markets tumbled Wednesday as Turkey doubled tariffs on some U.S. imports in the latest retaliation in what Turkey is calling an economic war. Joining me today is Steve Hanke, professor of applied economics at the Johns Hopkins University and a currency and commodity trader for the past 60 years. Welcome back, Professor.
Great to be with you.
So we saw the Lira rally today in response to Turkey's latest move against U.S. tariffs. Is this a short-term recovery, or is the Lira on the road to stabilizing from here?
There's no way the Lira will stabilize with the current system that they have. The inflation rate, as I measure it, is around 100% in Turkey right now on an annual basis. And that implies that to get a real yield that's positive, you'd have to have interest rates over 100%. And that, of course, that will kill the Turkish economy. But the Turks have done this over and over again. They just don't understand anything about the exchange rate system. They've completely melted down the Lira in 1994. They did the same thing in 2000, and now they've done it again. So they're slow learners.
I know you've said that one of the things Turkey could do to stop the further depreciation of the Lira is to anchor it to gold. How would that play out, and what do you think is the likelihood of that happening?
I really don't know the likelihood of it happening, but it would, under a currency board arrangement that was gold-based, the Lira would trade at a fixed exchange rate to gold, be freely convertible, and it would be fully backed 100% by gold. So the Lira would literally be as good as gold. The inflation would collapse from 100% down to almost nothing overnight, and the Lira would be just as stable as gold.
So do you think that would be their best bet? Because amongst their menu of options here, you know, what plan and options does the country have? Because they can't implement capital controls.
Well, with a gold-based currency board, you wouldn't. You by definition, you can't have controls. That is their best option. It's the only option to solve the Lira problem immediately and once and for all. That is it. There's only one option.
So if we were to, hypothetically play it out, what would that do possibly to the price of gold on this day that the metal's really hurting?
Well, it would probably, they would be adding reserves. Obviously, as the demand for the Lira went up, they would have to be accumulating gold, or they couldn't emit more Lira. So on the demand side, I would anticipate a positive element. Yeah. And as far as gold goes right now, today, the big problem is the Fed is clearly too tight in its monetary policy. If you measure the monetary growth using Divizia M4, which is the best broad money measure available, that number now is only increasing at about 4.8% per annum. And we have real GDP growth running around 4% or a little more. So that implies that an inflation is less than 1%. So that's tight. And we have gold now below $1,200 an ounce. I thought it would trade between $1,200 and $1,400 this year. Below 12, a little bit is tight. That signals a lot of tightness. The U.S. dollar on the dollar-euro exchange is below 120, which is tight. And the Fed is just too tight. The dollar is too strong. Right. It's killing the base metals. They're down about over 13% this year, and most of it's been occurring on the downside in the last couple of months. So the precious metals are down, the base metals are down. The monetary policy in the U.S. is way too tight, and in addition to that, we have problems in China. And China, it's all about monetary policy. The Chinese trend rate of growth in credit to the private sector is about 16%, and the current rate at which private credit is growing is about 9%. So it's weak.
So
M2, which is a broad money measure in China, is also the same thing. The trend rate's about 16%, and the actual growth in broad money is about 9%. So money dominates everything. Monetary policy dominates everything. The slowdown in China will occur. All you have to do is look at the money and credit growth figures, and you've got the story. Then we add on top of all this tightness in monetary policy, the fact that we have a trade war literally going on under our eyes, and that makes everyone quite nervous, and it particularly affects obviously the base metals.
And, wrapping this all together, Professor, as you suggest, the stronger U.S. dollar making life miserable for a lot of places and commodities here. So do you think the Fed will change course?
Well, I think they should change course. I think they'll probably defer interest rate hikes from where the consensus thinks these rate hikes will actually occur. I think they'll come later, but we have to wait and see. You never know about the Fed.
You never know. Professor, thank you so much for your thoughts today.
Thank you.
Thank you for watching. We'll be back tomorrow.